Imagine being at the Berkshire Hathaway annual meeting as thousands gather, waiting to hear the wisdom of the world's most famous investor. The crowd's energy pulses with anticipation, then Warren Buffett stands up, smiles, and surprises everyone. Instead of immediately boasting about his wins, he begins with a story of loss. He talks about Dexter Shoe, a company he once bought for $433 million in Berkshire stock, and how he watched year after year as that investment turned into a total disaster. The crowd is stunned as he admits not only did Dexter go bankrupt, but the shares he exchanged would have been worth billions today. It was worse than just a loss, Buffett says. It was a permanent mistake, one I wish I could take back every day. You look around the room and realize if even the Oracle of Omaha, one of the most disciplined, patient minds in financial history, can make a mistake that big, what about the rest of us? The scoreboard for investors doesn't just track winners, it keeps an unforgiving record of losses too. Buffett's pain is a sharp reminder. Most investors never see their mistakes until it's too late. If legends are still learning, how exposed are you? Welcome to Gray Finance, the channel where smart Americans come to master personal finance, investing, and the real-life strategies for building wealth and peace of mind. If you're tired of confusing retirement plans, overwhelmed by the ups and downs of the housing market, or wonder how anyone actually gets ahead in times like these, you're in the right place. Here, we turn complex money questions into simple, step-by-step roadmaps. Whether you're building your first investment portfolio, planning for retirement, navigating debt, or just trying to survive the next financial crisis. Hit subscribe, join the Gray Finance community, and take control of your financial future starting today. When you picture Warren Buffett today, it's easy to imagine he's always been destined for greatness, a financial genius who could do no wrong. But dig into his beginnings, and it's a very different story. His first big investment wasn't in a hot tech stock, but in a struggling textile mill called Berkshire Hathaway. Buffett bought in because he thought it was cheap and that he could turn it around, but he didn't fully understand the industry and underestimated the forces working against him. The result? Years of frustration and missed opportunity as his money sat trapped in a dying business that never truly recovered. He's admitted that buying Berkshire in its original form was the dumbest stock deal he ever made. And it wasn't a one-off. In his early years, Buffett fell victim to youthful overconfidence, believing his intelligence could overcome any challenge. He made rash moves and ignored basic business truths, often losing money or missing out altogether. What sets Buffett apart isn't some magical streak of luck or genius, it's his willingness to step back, face the pain of his losses, and change course. Most investors keep repeating what isn't working, convinced that next time will be different, but Buffett's greatest skill is relentless self-reflection. He turns regret into resolve. If you think investing success is reserved for the naturally gifted, remember, the world's greatest learned by failing forward. The only real mistake is never learning from yours. Are you willing to do what most people won't? Warren Buffett, despite his legendary discipline, once fell into the classic trap of chasing a hot tip. Early in his career, he heard promising whispers about Sinclair Texaco and couldn't resist. The excitement, the urgency, the sense that he was about to get in on something before the rest of the world, he would later confess, it all felt intoxicating. But the reality, the investment tanked, vanishing just as quickly as the hype. It's a familiar sting, acting on someone else's conviction instead of your own judgment. Fast forward to the late 90s. The dot-com bubble was in full swing. Stories raced around about people becoming millionaires overnight. It seemed like every cab driver and neighbor knew about a can't-lose internet stock. Buffett was mocked for staying out and even called out of touch by the financial press, but he kept calm and watched as fortunes exploded and then evaporated just as fast. The same cycle played out years later as meme stocks and crypto fever swept through social media. Buffett's principle was simple. If you're only interested because everybody else is, it's probably time to back away. It takes real courage to sit out when the crowd is running wild, but that's what separates a thinker from a follower. Are you buying because you understand and believe, or just because you want to belong? Millions vanish every year following tips, trends, and friends. If a legend can burn his fingers chasing a hot story, imagine the risk for everyone else. The next time something sounds too good to miss, ask yourself, whose conviction is it really? Overconfidence is the invisible hand that pushes even smart people off a cliff. Buffett knows this feeling all too well. He's openly admitted that some of his scariest moments as an investor came not from what he didn't know, but from what he was sure he couldn't get wrong. Take the topic of leverage, for example. Leverage is when you use borrowed money to amplify your gains, but it just as easily amplifies your losses. In the late 1990s and early 2000s, financial innovations like complex derivatives swept through Wall Street. Everyone seemed convinced the markets only went up. Some investors, many bigger and richer than Buffett, started betting with more borrowed money than ever. Buffett warned that derivatives were financial weapons of mass destruction. He saw what can happen when smart people, blinded by their own track record, forget that every market cycle has risks that are invisible until it's too late. He's written in his shareholder letters about the close calls he's had, times when he nearly lost far more than he ever wanted to admit. The lesson: risk always looks like something that only happens to other people until it happens to you. It's easy, in the glow of a bull market or after a string of your own wins, to start feeling bulletproof. But as Buffett knows firsthand, the line between confident and reckless gets thinner every day you're successful. Most people only notice the danger when they're already falling, and by then, the real damage is done. Are you humble enough to see risk before it hits, or will you only recognize it in the rear view mirror? There's an unspoken confidence that comes with a winning streak, tempting us all to believe we can outsmart the next challenge even if we barely understand it. Buffett's circle of competence is the answer to that temptation. His golden rule is simple: only invest in what you truly, deeply understand. Time and again, when he strayed outside his circle, the consequences were painful. Take airlines, for example. Despite decades of warnings about their cyclical nature, Buffett couldn't resist believing that this time it would be different. He bought heavy stakes in major carriers, and for a while, things went well. But as soon as market forces shifted oil prices, labor costs, an unexpected pandemic, the business turned against him. He had to sell everything for a loss, admitting, "I was wrong about that business." Earlier in his career, Buffett stayed out of technology stocks almost entirely. Not because he didn't think they made money, but because he admitted he didn't really get how they managed to stay ahead in such a fast-changing world. Later, when he finally broke his own rule and bought into tech giants, he only did it after years of deep research. The circle of competence isn't about being an expert in everything. It's about being honest with yourself about where your knowledge ends. One misunderstood business, one leap into the unknown, can unravel years of hard-won gains. Are you investing inside your circle or fooling yourself just enough to set up your next regret? The difference can define your financial future. Buffett's investment in Dexter Shoe is a chilling reminder that skipping your homework can be catastrophic even for the best. On the surface, Dexter looked like a winner, a profitable, Maine-based shoe company that dominated its niche. Buffett, impressed by its past performance and trusted reputation, bought the entire firm using Berkshire Hathaway stock. What he didn't do was dig deep enough into the competitive threats lurking beneath. He underestimated how quickly cheaper overseas manufacturers could eat away at Dexter's market. And there were warning signs in the financial statements, subtle declines in margins, and whispers that U.S. manufacturing was headed for tough times. In Buffett's own words, this decision was the worst deal I've ever made, losing not just hundreds of millions, but billions in potential future value thanks to the Berkshire stock he gave up. Shortcutting research isn't just a technical error, it's a shortcut of your own ambitions. It's passing up the discipline, the questions, and the curiosity that separate real investors from gamblers. Buffett's pain was public, permanent, and humbling proof that ignoring what you can't see is every bit as risky as what you don't know. Every investor is just one rushed decision away from wiping out years of growth. If you're tempted to trust a story, a friend, or a headline instead of your own eyes and hard work, remember Dexter Shoe. The hours you spend doing real research might seem tedious today, but skipping them could destroy a decade of progress in a single, silent slip. What are you risking by hurrying through your next decision? Investing can feel intoxicating when a company you believe in seems unstoppable. That's what happened to Warren Buffett with Tesco, a major British grocery chain he held for years. At first, Tesco looked like a classic buffet tea pick steady profits, a growing footprint, solid management. As challenges appeared, Buffett waited. He told himself it was just a rough patch, confident that things would turn around. But the longer he held, the more he became attached, ignoring warning signs like shrinking market share and deteriorating fundamentals. By the time Buffett finally admitted he was wrong, the losses were massive. He called it a huge mistake, and not because he couldn't read a balance sheet. Instead, it was his heart clouding his head. It's easy to become emotionally invested in a story, a brand, or even just an old winner in your portfolio. But the market doesn't care how much you love a stock. On the flip side, bad timing isn't just about acting too late. Sometimes the fear of missing out hits hard. When a stock is running and social media is buzzing, it takes discipline not to buy with the crowd. Other times, you might freeze overthinking, waiting for the perfect moment, and missing out entirely as opportunities slip by. Both urges, rushing in or clinging too long, are emotional traps that lead to regret. Buffett's career is filled with reminders that rational thinking must always trump gut feelings, no matter how strong. If you've ever held on when you should have sold, or jumped in just because everyone else seemed to be winning, know this: one bad call driven by emotion can erase 10 good ones. Will your next move be led by discipline or by impulse? The cost of getting this wrong is time you'll never get back. Modern investing culture worships speed. People chase the latest meme stocks, crypto surges, or earnings rumors, convinced that the next big thing is just one quick flip away from changing their lives. But Warren Buffett's career is living proof that real wealth grows slowly through the silent power of compounding, not by jumping in and out on a whim. Buffett often jokes that his favorite holding period is forever. What he really means is that the biggest wins come to those who plant seeds and let them grow, not those who dig them up every season to check the roots. He's watched countless investors sabotage themselves by selling too quickly right before the real magic happens. The excitement of a small gain blinds them to the truth. The most valuable profits are made in the boring, quiet years after everyone else has moved on. When Buffett does choose to sell, it's never because he's bored or wants to lock in a little green on his portfolio tracker. It's because the fundamentals have changed, not his mood. He's seen what happens to those who aren't content to wait. The lesson: patience isn't just a virtue in investing, it's a superpower. Every moment you spend wishing for results overnight, steals years off your financial trajectory. Sell too soon, and you not only miss the compounding, but spend a lifetime chasing after your own mistakes. If you're tempted to cash out on a tiny win, ask yourself, am I harvesting the fruit or uprooting the entire tree? The market rewards the patient, and every hasty move is money and time lost forever. Are you in this for the sprint or the marathon? The real rewards belong to those who outlast the crowd. There's a unique danger in thinking you have it all figured out, a feeling that you're smarter than the market, smarter than the experts, maybe even smarter than Warren Buffett himself. Buffett has warned about this many times, sharing stories where ego crept in and clouded his judgment. He admits he once looked past his own rules, assuming his track record would protect him. But the market has a way of humbling even the best. When Buffett stayed out of technology stocks for years, critics said he was behind the times. Out of respect for his circle of competence, he waited. Finally, after years of saying no, he made a move into Apple. That decision paid off, but he's the first to say that it came not from pressure or pride, but from careful study. He's also honest about the times he let his ego call the shots, like when he tried to save Salomon Brothers, thinking he alone could fix a struggling Wall Street powerhouse. The result wasn't victory, but stress, scandal, and a painful lesson in humility. Then there's FOMO, the urge to jump into whatever is popping off in the headlines, just because you can't bear to be left behind. Buffett deliberately sits out bubbles, even when everyone else seems to be getting rich. He watched the dot-com mania from the sidelines, resisting the pressure to join in. When the bubble burst, he was left standing while others were wiped out. Chasing trends and trying to prove yourself rarely ends well. If Buffett can admit he doesn't know everything, why take the risk of betting just to keep up appearances? The real winners aren't the loudest or the fastest, they're the ones humble enough to let the numbers, not their ego, drive every move. Warren Buffett's legendary caution about cash isn't just old school thrift, it's a carefully learned survival strategy. In 2008, as the financial world fell apart, most investors were either maxed out or forced to sell in a panic. While others scrambled, Buffett sat calmly on mountains of reserve cash, waiting for his moment. He swooped in to buy great companies at their lowest prices, deals only possible because he refused to bet the farm during the boom years. The same story played out during the COVID-19 crash, when his discipline allowed Berkshire Hathaway to weather the storm while others scrambled for liquidity. For Buffett, cash isn't wasted potential, it's optionality, a silent margin of safety that lets him strike when everyone else is stuck on the sidelines. He's been clear. If you don't keep dry powder ready, you give up the greatest source of wealth, building seizing opportunity in a crisis. Investors who stretch themselves to the limit, deploying every last dollar in the search for a little more yield, quickly find themselves exposed at the worst possible moment. A margin of safety isn't just some theoretical concept, it's a practical barrier against the unknowns that always surface. Markets don't warn you before they turn. Surprises don't ask if you're ready. Buffett's regret isn't that he sometimes had too much cash, but that he ever risked lacking it when the world changed overnight. If you're always all in, you risk standing helpless when fortune favors the patient and prepared. In investing, as in life, only those with resources on hand get invited to the real wealth-building table. Will you have the means to take your seat or watch from the outside as history is made? Warren Buffett's secret weapon is not just his knack for numbers or business deals, it's his relentless willingness to look in the mirror and admit where he went wrong. He publicly dissects his blunders in annual letters, never hiding from the ugliness or cost. This self-awareness is the key to his compounding edge. By facing mistakes head on, he's able to course correct faster than almost anyone else, turning setbacks into stepping stones for future growth. Take his experience with Dexter Shoe. After losing billions, Buffett didn't double down out of stubbornness. Instead, he owned the error, changed his acquisition strategy, and avoided similar mistakes with later deals, saving Berkshire countless millions over time. When he held on to bad stocks too long, he analyzed why, then implemented stricter sell discipline. Each brutal moment of honesty rewired his playbook, so compounding could finally work its magic uninterrupted. What separates Buffett from the average investor isn't perfection, it's this gift for transforming hard lessons into better habits. Most people shrink from their failures, hoping no one notices. Buffett shines a light on his, then looks for patterns to fix. That's how real wealth multiplies not by luck, but by relentless improvement, year after year. Imagine if every costly flaw in your past investing was simply the tuition for your next big win. Buffett's only real regret? Not identifying and repairing his errors sooner. Today, you can choose to do what the legends do, turn pain into fuel, mistakes into mastery. Which of these 12 lessons calls out to you now? Don't let just one of them hold you back. If missing even a single Buffett lesson keeps you average, imagine how your life could change by getting all 12 right. The fortune you want is waiting. If you felt even a single Buffett mistake hit close to home, you're not alone. Most people never get these lessons spelled out, let alone told how to act on them. That's exactly why Gray Finance exists. If you're ready to break average and start building your own legacy, check out the next video now, where I reveal the untold strategies wealthy Americans use to recession-proof their portfolios. Don't just watch, commit, comment, and join a community rewriting the financial future. Which Buffett rule will you follow first? Your journey starts right here on Gray Finance.